Hey everyone, Ian King here, editor of Automatic Fortunes, and welcome to the weekly Market Insights call. This week, I am joined by Ted Bauman, my colleague and editor of the Bauman Letter and the Alpha Stock Alert. Hey Ted,
How's it going, Ian?
nice to see you.
And you?
Uh, Thank you. And before we start, I just want to remind everyone to please subscribe to our YouTube channel. Click the link right here that says subscribe. And then if you want to get alerts in real time, also click the little bell. Ted, big news on the economy in the last few weeks. And I think that investors are kind of overlooking this kind of global slowdown that's happening right now. And you're seeing this in manufacturing PMI. I was really surprised when the US PMI came in last week below 50, and that's the first time in about a decade that the US is showing signs of contraction. It came in at 49.3. The level 50 is key sign for economists because it signals that the manufacturing sector is going into a contraction. What's your thoughts on that, Ted, and how do you think this will play out with what the Fed's planning on doing next week?
Well, Ian, I actually wasn't surprised at all. I think if you go back to the GDP figures that we saw earlier this year, we saw a lot of weakness in final consumer demand. We saw weakness in appliances. We know that automotive stocks have been hammered. You know that basically there's softness in companies that make things right now around the world, and part of that has to do, I think, with uncertainty around trade and tariffs. Not sure, how much one should be manufacturing for inventory, whether prices are going to go up or down on components and things like that. But the bottom line is that manufacturing is something that meets the classical kind of effect of the ripple effect. That it definitely has a ripple effect, and I think that means that we're going to need to be looking at other kinds of assets that are going to be immune from that kind of ripple effect. It doesn't mean that the stock market's going to die. I just think it's going to mean that we're going to see a rotation into different sectors.
Mm-hmm. And so what would you be advising your investors to really take a hard look at here with the economies really slowing down?
Well, I think one thing absolutely is to get on the gold bandwagon. It's the gold has just trounced the market so far this year. It's still doing well. Of course, it is sensitive to daily movements in the market. Today it was down a bit, but the overall trend is very much up. And I think we could see something like we saw between 2008 and 2012, when the price basically doubled. And that's a potential for pretty big earnings there. The second thing I'd be looking at is to pre-position yourself for the kinds of companies that benefit from an economic slowdown. Because one of the things that happens in a slowdown is that a lot of companies use the opportunity to trim fat. And I predict that there's going to be some significant restructuring of corporate management systems over the next decade or so, and it's going to be triggered by a recession. We're going to see cloud computing companies, I think, actually grow in value because of a recession, as companies use the opportunity to trim middle management, like they did with labor after 2008, 2009.
Ted, that sounds really counterintuitive. On one hand, you're saying the slowdown is coming, but then you're also saying that it's going to be good for some of these high-flying cloud stocks. Do you have any names in particular you can share with our audience that you are really bullish on in the cloud space?
Well, I think in general, the critical thing is to look at companies that are providing generic services that lots of different companies can use. So you got cloud companies can either be very specific to a particular vertical, like Viva Systems, which is very much focused on the pharmaceutical industry, or you can get companies that are kind of generic, like Fortinet, for example, which is a company that provides cloud security. And my rationale is that, after 2008, everybody knows that as bad as things get, we always bounce back. And I think corporate America has enough cash, has enough padding to be able to say, well, we know that if we have a recession, it's probably not going to last more than about 24 months. So let's use the opportunity to maybe cull some of our middle management. Let's start recreating our systems so that we're leaner when the economy bounces back. We have a more rapid growth in earnings per share, and therefore we do better. And I think they have the resources to do it.
And like you say, they've got cash on the balance sheet. There's one thing they're not afraid of doing, and that's buying back stock. So perhaps we'll see that same trend that we've seen over the last decade continue. Ted, I want to thank you for joining us today on Market Insights. It's great seeing you. And remember, if you like our YouTube channels, please subscribe to it. Hit the subscribe button. And if you like this, give us a like, please. Ted, nice to see you. Have a great rest of your weekend.
Great. And you too. And I'll see you next week in Florida at our conference.
Sounds great. See you then.